On the property and casualty exam, you absolutely must be able to distinguish between an umbrella and an excess liability policy. While both provide additional liability limits, they are not the same. An excess liability policy simply provides higher limits and nothing more. It follows the exact same terms as the underlying policy, which is why you'll see it called a follow-form excess policy. An umbrella policy, however, can provide broader coverage than the underlying policies. This is the key difference the exam will test you on. Think of a major lawsuit. Let's say your client has an auto policy with a liability limit of $500,000 and a $1 million umbrella policy. These primary policy limits are called underlying limits, and they must be exhausted before the umbrella policy pays. If your client causes an accident, resulting in a $700,000 judgment, the auto policy pays its full $500,000, and the umbrella policy pays the remaining $200,000. That's the straightforward part. The exam trap comes with a concept called the Self-Insured Retention, or SIR. The SIR is a form of deductible that only applies when the umbrella policy covers a claim that is not covered by the underlying policy. For example, a standard homeowner's policy excludes liability for personal injury like slander, but many umbrella policies will cover it. If your client is sued for slander for $50,000 and their homeowner's policy denies the claim, the umbrella policy will respond. This is called drop-down coverage. However, the client must first pay the self-insured retention amount. Let's say it's $1,000 out of pocket. After the client pays the $1,000 SIR, the umbrella policy drops down to act as the primary coverage and pays the remaining $49,000. Don't confuse the SIR with a regular deductible. A regular deductible applies to claims covered by the primary policy, while the SIR only applies when the umbrella policy is providing its unique, broader coverage for a loss the underlying policy excludes. An excess liability or follow-form policy would not provide this broader coverage. It only provides extra money for what's already covered. To remember this for your exam, use this phrase: an umbrella covers you from rain the primary policy doesn't see coming, while excess is just extra. This highlights that an umbrella provides new, broader coverage for unforeseen risks, whereas an excess policy just gives you extra limits for the risks you already have covered. For free practice questions, AI-powered explanations, and more exam prep tools, visit openexamprep.com. That's openexamprep, all one word, .com.